57,000. That is where the Nikkei 225 is trading right now, up over 16% year-to-date in 2026, while the Nasdaq 100 is down 2% and the Magnificent Seven are flat to negative. Japan's stock market is the best performing major index in the world. And here is the number that should really grab your attention. Japanese companies are on track to buy back 18 trillion yen of their own shares this year, more than 2 times the pre-pandemic level. Something fundamental is changing in the world's third largest economy. I'm Alex.
And I'm Maya. Welcome back to Asia Tech Macro. Okay, Alex, I feel like Japan has been the next year story for decades. Every few years, someone says, this time Japan is different, and then it fizzles out. So why should anyone believe this rally is the real deal?
That is the exact right question. And honestly, I was skeptical too until the data became undeniable. Let me walk through the 3 pillars of this rally, because they are structurally different from previous Japan head fakes. Pillar 1 is Sanaenomics. Prime Minister Takaichi secured a historic electoral mandate in February 2026, and the Nikkei crossed 57,000 for the first time in response. Her economic program centers on what she calls crisis management investment, a 21.3 trillion yen stimulus package with aggressive spending on AI, semiconductors, cybersecurity, and defense.
Wait, that is a massive stimulus. 21.3 trillion yen is roughly $135 billion. And on top of that, the regular budget for fiscal 2026 totals 122.3 trillion yen. That is an extraordinary level of government spending.
It is, but here is what is interesting about Takaichi's approach compared to, say, Abenomics a decade ago. She is explicitly coupling fiscal stimulus with fiscal discipline. New government bond issuance is capped at 29.6 trillion yen, below 30 trillion for the second straight year, and debt reliance has actually fallen from 24.9% to 24.2%. She is spending more but borrowing less as a proportion of the budget. That is a genuinely unusual combination.
So she's threading the needle. Stimulate growth without terrifying bond markets. That is politically savvy.
Pillar 2 is corporate governance reform, and this is where things get really exciting for investors. Japanese companies have historically been notorious for hoarding cash, holding cross-shareholdings, and ignoring shareholder returns. But that era is ending at an accelerating pace. Total shareholder return ratios for Japanese companies reached 60% in fiscal 2024, which is now on par with European companies. Share buybacks surged to nearly 3 times their prior year level. Toyota simplified its group structure by reducing cross-shareholdings. These are structural behavioral changes, not one-time events.
And Goldman Sachs Asset Management just put out a piece highlighting that Japan offered what they called potential opportunities for alpha-enhanced investing. That is Goldman speak for, we think there's money to be made here.
Janus Henderson published an analysis asking whether strong earnings growth and policy credibility will drive Japanese stocks higher in 2026. Their conclusion was that Japanese corporate earnings per share growth is expected at 8 to 9% in 2026, which combined with expanding buybacks and dividend increases for the 5th consecutive year creates a compelling case.
Okay, so we have massive fiscal stimulus, corporate governance transformation, and strong earnings. What is Pillar 3?
Pillar 3 is the weak yen, and this is where it gets controversial. The yen is currently trading around 157 to the dollar. That is an extraordinary level of weakness, and it is both the greatest accelerant and the greatest risk to the Japan trade. A weak yen supercharges Japanese exporters. Toyota, Sony, Hitachi, their overseas earnings translate back into more yen. It inflates equity valuations, and it makes Japan incredibly attractive for foreign tourists and foreign investors buying Japanese assets at a discount.
But the flip side is that a weak yen crushes Japanese consumers through import inflation. Energy, food, raw materials, everything Japan imports gets more expensive. So the stock market booms while households feel squeezed. That is the paradox in the title of today's episode.
And here is a data point that perfectly captures this paradox. Inbound tourist spending in Japan hit 9.5 trillion yen in 2025, a record. Foreign visitors are flooding in because Japan is astonishingly cheap in dollar terms. A Michelin-starred sushi omakase in Tokyo that would cost $300 in New York runs about $120. But while foreign tourists are celebrating the bargain, Japanese households are paying 20 to 30% more for imported food and energy compared to 3 years ago. The same weak yen that makes the country a bargain paradise for visitors makes it more expensive for the people who live there.
So we have this bizarre situation where foreign investors are getting rich on Japanese stocks, foreign tourists are getting incredible deals on Japanese experiences, and Japanese citizens are struggling with rising grocery bills. That is quite the economic contradiction.
It is, and it is not sustainable in its current form. Something has to give. Either the yen normalizes and some of these dynamics reverse, or Japan finds a way to channel the benefits of the weak yen back to domestic consumers through wage growth and fiscal policy. Right now, the government is trying to do both at once. Whether they succeed is the trillion-dollar question.
Let's dive deeper into the tourism story, because I think it really illustrates the cheap Japan phenomenon and its limits. Japan welcomed a record 42.7 million international visitors in 2025, and total inbound spending hit 9.5 trillion yen, up 16.4% year over year. Those are staggering numbers.
They are. But here's where the story gets more nuanced, and this is the part most headlines miss. The Japan Travel Bureau Foundation has forecast a 3% decline in total inbound arrivals for 2026, and arrivals from mainland China, which had been Japan's largest international market, plummeted 45.3% in December 2025 compared to the prior year.
Wait, that is a huge drop. What is driving the Chinese tourist decline?
Multiple factors. The Chinese economy is slowing, youth unemployment remains elevated, and there is a broader consumption downgrade trend in China, where middle-class consumers are cutting discretionary spending, including international travel. There are also lingering political tensions between Beijing and Tokyo that have dampened enthusiasm for Japan trips among some Chinese travelers, and the ongoing Fukushima treated water discharge has been weaponized in Chinese social media to discourage Japan travel.
So Japan's tourism boom might have peaked? That seems like a significant headwind.
Well, not necessarily peaked, but definitely shifting. Per capita spending is where it gets interesting. While total visitor numbers may dip, spending per visitor from Western countries, particularly the US, Australia, and Europe, has been rising sharply. These travelers are staying longer, eating at higher-end restaurants, staying at luxury hotels, and buying more. The weak yen makes Japan feel like an extraordinary value proposition for anyone earning in dollars, euros, or pounds. A Michelin-starred meal in Tokyo that would cost $300 in New York costs $120 here.
And that creates an interesting tension within Japan, right? Because the places that foreign tourists love, Kyoto, Tokyo's luxury districts, Hokkaido, are seeing prices bid up by foreign spending power, which prices out local Japanese consumers.
Exactly. This is what Japanese media calls over-tourism, and it is becoming a genuine social issue. Kyoto residents have been vocal about the strain on local infrastructure, rising rents, and a sense that their city is being turned into a theme park for wealthy foreigners. The government is trying to spread tourism to less visited regions, but the concentration remains extreme.
Let's zoom out and talk about the broader wage and inflation picture, because this is where the BOJ policy comes in. What are wages doing?
This is arguably the most important development in Japan in 30 years. For the first time in decades, wages are growing meaningfully. Several major labor unions set wage increase goals above 5% for fiscal 2026, matching the high levels achieved in fiscal 2025. BOJ board member Takaichi noted in a February 2026 speech that most firms expect to raise wages at about the same rates as fiscal 2025, when high wage growth was realized.
5% wage growth in Japan. I mean, for anyone who has been covering Japan for a while, that sentence would have been science fiction 5 years ago. Japan spent 30 years in a deflationary trap where companies refused to raise wages because they didn't believe prices would stick. What changed?
Three things converged. First, the labor shortage. Japan's working-age population is shrinking by about 600,000 people per year. Companies literally cannot find workers, so they have to pay more to retain talent. Second, inflation finally arrived and became persistent. Core inflation, excluding fresh food and energy, is running well above 2%. Workers are demanding higher pay because their cost of living is genuinely rising. And third, there is social pressure. The government and media have made wage increases a national priority. There is a cultural shift happening where it is now expected, even demanded, that companies share profits with employees.
And the BOJ is watching this carefully, right? Because sustained wage growth is exactly what they have been waiting for to justify further rate hikes.
Precisely. The BOJ's current policy rate is at 0.75% after the January 2025 hike. The market expects 2 more quarter-point hikes by the end of 2026, bringing the rate to 1.25%. ING and Nomura both expect the next hike in October 2026, though if the yen weakens further and import prices spike, they might move earlier, potentially in Q2. This is still incredibly accommodative by global standards, but for Japan, where rates were negative just 2 years ago, it represents a seismic shift.
And here is the tension. If the BOJ raises rates to strengthen the yen and tame inflation, the stock market rally could stumble. Remember what happened in August 2024? The BOJ's surprise rate hike triggered a historic carry trade unwind, and the Nikkei dropped 12% in a single day. That ghost still haunts the market.
All right, Maya, contrarian corner. And today I have a take that will make the Japan bulls uncomfortable. Here it is. The Japan is back narrative is actually a weak yen mirage. And when the currency normalizes, a significant chunk of the stock market gains will evaporate.
Okay, that is directly challenging everything the bulls were saying. Walk me through it.
The consensus view is that Japan is experiencing a structural transformation. Corporate governance reform, wage growth, Takaichi stimulus, all creating a virtuous cycle. And there is truth to each of those elements individually. My contrarian argument is that the single most important driver of the rally is the yen, and the yen is at a historically anomalous level that cannot persist indefinitely.
How much of the rally is attributable to yen weakness versus fundamentals?
Let me put it this way. The Nikkei is up about 16% year-to-date in yen terms, but if you convert those returns into US dollars, the performance looks much less impressive because the yen itself has depreciated. A foreign investor who bought the Nikkei in dollars has seen decent but not exceptional returns. The gap between yen-denominated and dollar-denominated returns is the yen subsidy embedded in the rally. CNBC ran a piece in February 2026 calling the rally fragile, specifically because, and I quote, currency normalization could take quite a big chunk out of where equities are right now.
That is a really important distinction. So Japanese stocks look incredible in yen, but less so in real purchasing power terms.
Exactly. And here's the deeper problem. The weak yen is not a policy choice. It is a consequence of the interest rate differential between the BOJ and the Federal Reserve. As long as U.S. rates are at 4 to 5% and Japanese rates are at 0.75%, capital flows out of yen into dollars. But if the BOJ raises rates toward 1.25% by year-end and simultaneously the Fed starts cutting, that differential narrows. The yen strengthens. And every 1% move stronger in the yen mechanically reduces the yen-denominated earnings of Japanese exporters.
So the paradox is that the very success of BOJ normalization, proving that Japan has escaped deflation, undermines the currency weakness that is powering the stock rally.
Precisely. Success kills the trade. If wages keep rising at 5%, if inflation stays above 2%, the BOJ has to normalize faster. Faster normalization means a stronger yen. A stronger yen means lower export earnings. Lower export earnings means stock price corrections. The bull case and the currency case are inherently contradictory over a multi-year horizon.
But let me push back. Isn't the corporate governance reform story independent of the yen? Buybacks, dividend increases, cross-shareholding unwinds, those are structural changes that create value regardless of the currency.
That is the strongest counter-argument, and I partially agree. The governance reforms are real and durable. But let me quantify it. Japanese corporate EPS growth is expected at 8 to 9% in 2026. If the yen strengthens 10% from current levels, which is entirely plausible if the BOJ hikes twice and the Fed cuts, that 10% yen appreciation would wipe out most of that earnings growth for exporters like Toyota, Sony, and the trading companies. The governance improvements are real, but they are not large enough to offset a meaningful currency move.
And there's another risk I want to flag, the tourism contribution. We said inbound spending hit 9.5 trillion yen in 2025, but that revenue is predicated on Japan being cheap. If the yen strengthens from 157 to, say, 135 to the dollar, Japan suddenly becomes 20% more expensive for foreign tourists. The tourism boom was built on currency weakness. Remove the currency advantage, and Japan is just another expensive developed country.
And then there is the demographic headwind, which the rally narrative conveniently ignores. Japan's population declined by over 800,000 in 2025 alone. The working-age population is shrinking at 600,000 per year. No amount of corporate governance reform or fiscal stimulus can offset a structurally shrinking domestic consumer base. The bulls will say, but productivity improvements in automation. Fine, but show me the data. Japan's labor productivity growth has been consistently below the OECD average for 2 decades. There is no evidence yet that AI or automation is closing that gap faster in Japan than elsewhere.
So your contrarian view is that the Japan rally is real but significantly overstated, propped up by an unsustainably weak currency that masks underlying structural weaknesses.
That is exactly right. I am not saying Japan is uninvestable. The governance reforms are genuinely positive. The wage growth is historic. But the magnitude of the rally has overshot what the fundamentals justify, and the weak yen is flattering the numbers in a way that will reverse. When the yen normalizes, and it will normalize, the Nikkei will give back 15 to 20% of its gains. That does not mean Japan is a bad investment. It means it is a good investment at the wrong price.
All right, Maya, let's close with 3 action items for our listeners.
Action item number 1?
Number 1, hedge your yen exposure if you are long Japanese equities. This is the most practical advice I can give. If you own Japanese stocks through an unhedged ETF like EWJ, you are making a bet on both Japanese corporate fundamentals and yen weakness. If the yen strengthens, you lose on currency even if stocks go up. Consider whether a yen-hedged vehicle like WisdomTree's DXJ makes more sense for your risk profile. The cost of hedging is relatively low right now because the interest rate differential still favors the carry, but that window is closing as the BOJ normalizes. The time to hedge is before the yen moves, not after.
That is very specific and actionable. Currency hedging for Japan exposure. What about number 2?
Number 2, focus on domestic-facing Japanese companies rather than exporters. The consensus Japan trade is to buy exporters, Toyota, Sony, the trading companies, because they benefit from the weak yen. But if I am right that the yen will normalize, those export-heavy names face the biggest headwind. Instead, consider companies that benefit from domestic structural trends, wage growth driving consumption, tourism infrastructure, automation and robotics addressing the labor shortage, and financial companies that benefit from rising interest rates. Japanese banks like Mitsubishi UFJ Financial Group and Sumitomo Mitsui Financial Group are direct beneficiaries of BOJ rate hikes. Insurance companies benefit from higher investment yields. These domestic plays are less sexy than buy Toyota for the yen trade, but they have much lower currency risk and arguably better risk-adjusted returns.
I love that reframing. Instead of betting on yen weakness continuing, bet on the domestic transformation. And action item 3?
Number 3, watch the spring wage negotiations, known as shunto, as the single most important leading indicator for Japan. The shunto results, which typically come in March and April, tell you everything you need to know about the trajectory of Japan's economy. If wage increases come in at 5% or above for the 3rd consecutive year, that confirms the wage price spiral is self-sustaining and the BOJ will normalize faster. If wage growth disappoints, below 4%, it signals that the deflation mindset is not fully broken and the entire Japan is back thesis weakens. This year's shunto is particularly important because it will show whether small and medium-sized enterprises can match the wage gains of large corporations. BOJ board member Takaichi specifically flagged this in his February 2026 speech, noting that small firms may struggle to raise wages as much as large firms due to delayed pass-through of cost increases to selling prices. If the shunto shows a widening gap between large and small company wage growth, that is a structural problem that undermines the consumption recovery.
That is a great point about the SME gap. Japan's economy is dominated by small businesses. If they cannot afford to raise wages, the majority of Japanese workers will not see meaningful pay increases, regardless of what Toyota or Sony announce.
And that bifurcation is the real story beneath the headline numbers. Japan could be evolving into a 2-speed economy, large globally competitive companies that are thriving, and a vast domestic SME sector that is struggling with costs, labor shortages, and inability to raise prices. That is not the picture of a uniformly back economy. It is a more nuanced and, frankly, more fragile reality than the Nikkei at 57,000 suggests.
So the takeaway is, Japan is genuinely transforming, but the transformation is uneven, the currency is masking risks, and the rally has likely overshot.
That is my read. And here is the line I want listeners to remember. Japan's stock market is having its best decade in 30 years, but the best decades are exactly when discipline matters most. The time to be cautious about Japan is not when things look bad. It is when things look this good, because markets price imperfection, and perfection rarely arrives.
And I want to add one more observation. BlackRock's iShares team published a piece titled Why 2026 Could Be a Promising Year for Japan's Share Market. Their argument was that Japan is entering a new phase as net foreign flows surge into Japanese equities. Foreign investors are rotating out of expensive U.S. tech into Japan as a relative value play. But as you said, Alex, if that rotation is primarily driven by the currency discount rather than fundamental value, the rotation could reverse just as quickly when the discount disappears.
Exactly. And Japan entering a new phase is a phrase that has been used about 10 times in the last 30 years. Each time, there was genuine optimism backed by real data, and each time some structural headwind, whether demographic, deflationary, or political, eventually reasserted itself. I genuinely believe this time has the strongest fundamental case of any Japan rally in decades. But the strongest fundamental case in decades and a guaranteed outcome are 2 very different things.
Well said. And coming up next, we're diving into ASML's impossible position, caught between U.S. export controls banning its machines from China and China being its fastest growing market, the geopolitics of the most important machine in the world. Do not miss it. Thanks everyone for listening.
Stay data-driven. Bye.